Hi everyone, I'm Gio.
And I'm Oscar.
This is The Come Up. Today we're going to mention some things you need to know if you're interested in buying a house.
Okay, so if you are like most of us, and when you want to buy a house, chances are you're going to need a loan. So we're going to talk about what are some of the factors that are required for you to be able to improve your chances of getting that loan. I'm just going to mention right out of the gate that some important ones are going to be that you're going to need to have proof of income. Often they're going to ask, lenders are going to ask for at least 2 years of taxes. So they want to see that you've had steady income flow so that they can assess the risk of you being able to pay the mortgage, right? Because they want to make sure they get paid. Okay, so there are three main factors that a lender will want to look at that impact your ability to qualify for a loan. The first one is debt to income ratio. And essentially what this is, if you have a monthly recurring debt, such as a car loan or student loans, you take that and you add it up with the estimated payment that you're going to have on whatever home you're going to purchase, and you add them all together, and this is going to be what you're going to be paying out every month, right? Assuming you get the house that you want, and you divide that number, the debts that you're paying every month, by your gross income that you make every month. So gross income just means all the money that you make before taking out taxes, deductions to 401k contributions, all that. Essentially what the Consumer Financial Protection Bureau recommends is that number, your debts, be 36% or less in order for you to just have greater chances of being able to get a loan on terms that are going to be favorable for you. According to the Consumer Bureau, the highest debt to income ratio that you can have to qualify for a loan is about 43%.
Another factor for getting a loan for a home is going to be your credit score, which is one of the reasons we've been stressing credit scores throughout multiple videos. Typically, you're going to need a credit score somewhere above 620 in order to get a loan. But the lower you are, the closer you are to that 620, the higher interest rate that you are going to pay, regardless of who your lender is going to be. Typically, once you start crossing into the 700s and even better, the mid 700s, then at that point you will be receiving better interest rates and better terms generally for your loan. Another factor that will impact your mortgage is going to be a down payment. On the higher end, you could save up to 20% for a mortgage, and you would at that point get the best possible terms. And if you actually met the 20%, you would avoid a thing called PMI, which stands for private mortgage insurance, which is an extra charge that banks apply to your payments when you make them. If you don't put down the 20 and put something less than 20, then you will have that PMI as part of your payment. So your payments will be a little bit larger. On the lower end, if you're a first-time homeowner, or if you're going to be a first-time homeowner, you can apply for a FHA loan, which requires a minimum of 3.5% down.
And one thing I'll just add, for condos, if you want to get the best rate, typically you'll have to put down 25% down payment. Even though 20% will be enough to avoid PMI, usually they'll ask that you do that extra 5% to get the best rate available. I had to learn that by going through the process. Okay, so now you know the three main factors that affect your ability to get a loan. We wanted to start there because, well, it's important to know how much loan you qualify for and what's it going to take. What kind of income do you need to be able to get that loan? And based on the income that you have, how much loan can you get? So next, we're going to talk about a little bit of just the process from my experience anyways, and our experience. I started window shopping way in advance of buying my first house because it's free, and it's fun. Why not?
Yeah.
You can go on Redfin.com. There's all these websites, Zillow. I personally like Redfin, and you can browse around, look at the map. You can set your own filters for what price level you want, what type of homes you want to see: townhomes, condos, single-family homes. So they make it pretty easy for you to go in there, window shop. And I say it took me about probably from the point where I started window shopping to the point where I bought my condo was probably like 2 years. And so the more time that you can give yourself, chances are the more you're going to get a feel for what's the price, what's a good price in the market, what's a good deal, and that you'll be able to get a better deal. One other thing that I like about Redfin is they have a calculator that shows you can move a little lever on there on how much you want to put as a down payment, and it'll calculate for you how much you'll have to pay estimated monthly. Now, it may not be exact, but it should be relatively close on what you're going to have to pay in taxes, mortgage, insurance. If there's PMI, I think it automatically puts it in there. The one thing that I sometimes have to manually look in there for and make sure it's correct is HOA, or if there's a land lease. But just personally, I'm not a huge fan of land lease properties.
Don't recommend it.
It's because you're paying money to somebody else owns the land. But for some people, if that's that might make sense for them. Just not a personal fan myself. Okay, so I'm gonna go into my experience with buying my first property. It was a condo I bought in Southern California back in 2015. I was able to get a good price on it. I was able to buy it for about just under $250,000. That is a good price, believe it or not, for those that are not in Southern California. And so what did the calculations look like for me, right? Debt to income ratio. Since I lived at home with my parents at the time, I was essentially able to tell the lender that I had no recurring monthly expense. And so all they looked at was the mortgage that I was going to be getting, and I was going to be paying about $1,600 a month. So for the debt to income ratio, that's the top. And then the bottom, I was making, I want to say about $65,000 a year. So if you divide that on a monthly basis, that is about $5,400 a month. So if you do that math, $1,600 divided by $5,400, that was a debt to income ratio of about 30%. I'm just going to round up. And so I'm still below that recommended 36%. And I was able to get the loan. I put in my offer. I used as an agent one of a friend of mine that I knew, and lo and behold, they accepted it. So what about my down payment? I put down 20%. I was able to get a good rate, not the best rate again, because I didn't know you needed to put down 25% for a condo, and so that left me with a loan of about $200,000. And lastly, as far as credit score goes, fortunately I didn't have any issues with that. I want to say my credit score was over 700, and the reason I mention this is not to brag, but just to give you an idea of how I was able to go through and purchase my first home. And yeah, it's incredibly, steep learning curve. If it's something you're doing for the first time, it can make you nervous. But you got to start somewhere if it's a desire of yours. And so I wanted to share this experience so that in our hopes it'll be helpful to those of you that do want to buy a home.
So my story has some similarities and some differences with his. I bought my house in the Midwest, which is obviously not Southern California and much cheaper than Southern California. I bought my house in the Midwest. I bought it in 2015, so that's very similar. at that point in my career, I was also making in the 60s. I don't remember the exact number at the time. For a down payment, I put down 7%. So 7% down payment on a property that was worth $137,000. It was a pretty good deal. I still ended up getting, my mortgage was about $1,100 a month, and yeah, that's basically the house that.
I know this won't make it on the video, but so why'd you move back here?
What are you thinking?
I didn't want to buy a house over there. I wanted to come back.
Gio loves LA that much.
I love LA that much.
Let's not even do the likes this episode. Let's just leave it and see what happens.
See what happens. See.
Likes.
Like and subscribe.
Likes. Oh,
yeah.
Okay.
Yeah.
See if reverse psychology works.
Yeah, exactly. Don't like this video.
Do not subscribe.
We're going to put some links in the comments to the calculators that will help you determine how much loan you qualify for. So you'll just put in there what's your monthly income, and it'll have some pre-populated fields on property tax, the average, and it'll tell you here's the loan that we recommend that you can qualify for. And that is about the extent that we're going to cover. There's a lot more to this real estate thing that we haven't covered here. This is, was very high level, introductory. So we hope you found it useful. And
Thanks for watching.
Thanks for watching. We'll
see you around.